Good morning, everybody. This is the live market open for Wednesday, February 24th. I'm Yohay Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. Okay, today as usual, good morning, everybody. We'll talk about, of course, what happens in markets. We're seeing a stronger US dollar in general, not only risk off or risk on. Charts and levels, next 24 hours, and of course, most importantly, your questions. I already see a few comments. Anyway, if you cannot see the chat box, please go to the address on the screen, tlk.io/fxstreet-forex-live-video. Okay, market mood is not so happy anymore. Why is that? First of all, the best bellwether is oil. Oil prices are suffering. Iranians said very clearly that cutting production sounds ridiculous. The Saudis said that they will not cut production and that OPEC will not play its role as a swing producer. And this has a negative impact on oil prices, on stock markets, and in general. Okay, so let's look a bit at currencies and then talk about the events we had yesterday. So let's see if we have a few questions here. Hi, Carol, with the nickname Morning All. Hi, everybody else. I see quite a few of you in the room. So let's look at a few charts. I think most interesting, remains the British pound. Remember, recap, EU deal reached on Friday between David Cameron and his counterparts. He decided to hold a referendum on June 23rd, came home, and major political figure, Boris Johnson, Mayor of London, decided to oppose it. Also, one of his ministers opposes it. It triggered a Sunday gap, and since then we've seen the pound deteriorating, okay? The latest polls do show a sort of relatively tight game. We had the YouGov and Commerce polls coming out. It's one of the reasons for this extension of the fall. There is uncertainty about the result of the referendum, Brexit or no Brexit, but also the fall in oil price. The worst market mood is sort of pushing money towards the more safe havens, and the pound is not a safe haven. So we finally had, during the Asian session, pound dollar fall under the very round level of 140. Okay, the low so far has been 139.64, and it attempts to recover. We've seen them already early in the European session. We went above 140, but we never stayed there. We're back under 140. We're seeing, as we speak, a fresh deterioration in the pair. Okay, so in the last, this happened in the Asian session, and the deterioration continues. Here's an attempt to break back above these levels, and the failure. I see 140 still as resistance. Support, well, we have immediate support only 7 pips away because it was the low only a few hours ago, 139.64. I think we could see the pair fall further. The lines, if we look back, they date back to March of 2009. Actually, the last time the Bank of England changed its interest rates. Okay, so we're back to levels last seen. Yeah, right here, and during this time in March 2009, we had the pair fall to much lower levels of around 136.60, and around the financial crisis in December 2008, early 2009, we had it fall to, well, under around 135. Okay, so all in all, the pound has really lots of room to fall to the downside after breaking under the round number of 140. That's a dramatic event for today. I think that 139.64 is not the final level. Okay. Euro dollar. This is what's different today. We have worse mood in markets, falling oil prices, falling stocks, but the euro is failing to recover. Okay. Less demand for the euro, more worries about the ECB, and also bad data yesterday. We had already a fall under 110 yesterday, but then we had a recovery, a struggle with this level. The pair now is moving down once again. Okay, this happens in the last hour or so, losing 110 once again. 109.50 is some kind of support, but the moves here are very, very gradual. So all in all, the picture is of stronger stronger US dollar across the board. So yeah, support here, which we haven't seen for quite some time, is 109.60 or something like that. Anyway, we're down to a lower range. We fell under 110.70, and now the lower range is well, 110 is hardly working as support. So 109.60 I would say is the next level of support, followed by very, very strong 107.70 is some support. 107.10 is really, really strong support, but we have lots of room to the downside from there. Okay, dollar yen also. You would expect the worst market mood to push the yen lower, but perhaps there is hope that the Bank of Japan will do something. So I can't say the Japanese yen is losing to the US dollar, but it's very stable. It's not the typical risk-off reaction where we've seen the yen strengthening against everybody else, including the euro, including the dollar. The dollar yen is very, very stable. So it's not deteriorating. Sorry, the yen is not falling, but it's also not rising. Again, US dollar strength across the board. And let's move to the commodity currencies. No, just mentioned 111 is support and 113.20 is some kind of resistance over there. Now let's move to the more obvious currency pairs. When we have a worse market mood, we have commodity currencies falling. So we have dollar CAD back above 137.87, currently struggling with 138, higher on the day, higher than the low seen above support at 136.20. Of course, the result of falling oil prices. Let's jump to oil prices. 31.50, the trend here is clear. We had moved to the upside, better market mood, almost $34, and since yesterday, an ongoing deterioration. We had a fall yesterday, and this fall continues. This morning, it's not as sharp as we've seen it yesterday, only just under 1%, and yesterday it was about 3-4%. Anyway, falling oil prices, $31.30 is the level of support for WTI crude oil. Aussie dollar, yesterday it made a nice move above 72.20. I still think 72.20 is a very, very nice separator of ranges. You reached almost 72.60 under support at 72.80. Worse market mood, things are deteriorating once again. Back to the previous range of 71.40 to 72.20. Here it's very clear, bad market mood, weaker Aussie. Same with the Kiwi range here. Well, currently it's holding above the round number of 66, but 65.50 is support, 67 is resistance. Okay, dollar Swiss, 99.49 at the moment. Parity works as strong resistance. Remember, it's not the safest pair to trade. 99 works as support. Euro Swiss, well, it fell. That means the Swiss National Bank doesn't do enough. Yesterday we heard from the Swiss National Bank that they're not able to do everything all the time, but they are well, they are intervening perhaps a bit less. 109.40 at the moment. I would say that 109 is some kind of support, or 109.20. Anyway, we could have an intervention here by the S&B to boost the pair. Euro pound, of course, while the euro isn't the strongest pair at the moment, isn't the strongest currency at the moment, we are seeing the pound suffering much, much more. 78.50 works as support at the moment. We already got very, very close to 79 yesterday. So I would say 78.50 to 79 is the current range on euro pound. Okay, euro yen. The yen is a stronger safe haven, even though it's not working that well as a safe haven. Currently 123.20, free falling, support at 123. Okay, for euro yen. And pound yen, the bottom, there is no bottom to the barrel and to the Boris Brexit backing. Anyway, 150 we touched, just dropped under 156 and then bounced back up. remember just a few months ago, we were above 180. It's quite a free fall over here. The pound is, of course, suffering, and the yen is relatively stable. Again, not the strongest safe haven, the strong safe haven that we've used to know, but certainly strong enough. Okay. Yeah, so we talked about all these pairs. Let's see if you have any questions. And then I'll talk about other... Okay, thanks, Linda, for helping out with the nickname here of Carol. Okay. Anyway, we talked about major pairs. Let's talk about the events that we had yesterday that did have their impact as well. Okay, so we talked about the mood. First of all, the German IFO business climate disappointed. It came out worse than expected. Okay. And where do we have it? Right here. So yeah, this is, as you can see, we have a few figures here, but this is the most important one. Business climate expected to fall from 107.3 to 106.7, and we fell to even lower ground at 105.7. This reflects worries about the German economy moving forward, Chinese demand, things like that. We did have the current assessment come out better than expected, but business climate, the most important part, and expectations also deteriorated under 100. So worse expectations for the German economy from Germany's number one think tank certainly hurt cast worries about the next the situation in Germany, in the Eurozone, and perhaps implies more action from the ECB. Okay. In the US, we had mixed data. Existing home sales came out better than expected, but consumer confidence was weak. But it was generally mixed. So here we are. We had existing home sales coming out at 5.47. Actually, a small rise from last month. It was expected to fall to 5.32. So that was the good news. But the bad news came from consumer confidence, which was expected to slide just a bit from 97.8 to 97, and it fell all the way to 92.2. Again, the correlation between confidence as measured by these various surveys, the University of Michigan, the Conference Board, and actual retail sales is not always correct. So we'll have to wait and see for the retail sales report for February, released in mid-March. But anyway, this consumer confidence figure is not so positive. Okay, and yesterday we also had the Bank of England's appearance in front of Parliament, the inflation hearings. Anyway, we heard nothing new from Arcarney. Another one of his members, Shafik, said that the next move is still raising rates, but and that markets are a bit went too far with pricing out a rate hike. So it's slightly bullish words, hawkish words from the Bank of England, but not coming from Arcarney, and also coming out on the background of extreme worries about Brexit. We know regarding a Brexit that the Bank of England has made and is updating its contingency plans. What does that mean for markets? Nothing at the moment. Needless to say, markets want the UK to stay in the EU. More stability, less uncertainty. Yeah, okay. What else do we have yesterday? We had Australia wages. Actually, didn't even check out what the outcome was. Let's take a look at the actual figures. As expected, well, slightly less. It was expected 2.3. Yeah, year over year, the outcome was 2.2. So nothing really significant over there. So it's mostly about the market mood. So good morning, everybody. Sinatra, Carol, good to see you back with the real name. And I see quite a few of you in the room. You're all welcome, of course, to ask questions, okay? And let's continue with what else we have on the agenda today. So today we have a very, very light European morning. Nothing really of importance worth mentioning. Maybe I'll take another look just to verify I didn't miss anything, but We have, we had consumer confidence from France, not so important, slightly below expectations. Industrial output from Italy, very, very second tier, third tier. Perhaps this is of slightly higher importance. The British Bankers Association mortgage approvals, okay? I don't think we even have expectations for that. We do have. They're expected to rise from nearly 44,000 to 45.2 thousand. And at 11 GMT, we have the CBI distributive trade survey expected to fall from 16 to 12. In regard, these might be important figures for the pound, okay? I mean, these figures could be telling about the state of the British economy, but markets are so obsessed at the moment with Brexit or no Brexit, what Boris said, what George Osborne says, what Labour says, what everybody, and of course the most recent polls, that these figures, which are not the most important ones in the UK, will have less significance. So let's move all the way to the United States of America. We have the market services PMI. Remember, market is not as important as ISM regarding the US, but it's still worth mentioning. Especially, it's a preliminary figure for February. That means it's early, and it's the services sector, which is the largest. So we're expecting a small rise from 53.2 to 53.5 points. Okay. Let's see. It's of course lower than previous months. Look, here's the chart showing that in early 2015 the situation was better, and also during 2014. So it's slightly lower. Again, this is not the most, doesn't have an impact like ISM. And we've seen in early February, when we had the ISM non-manufacturing PMI, services sector PMI, that was huge. It was disappointed badly, and the dollar just collapsed. Market has less influence. Okay, so let's talk about what is important. New home sales. Okay, yesterday we had better than expected existing home sales. New home sales are more important because every sale of a new home triggers more economic activity, infrastructure, schools, hospitals, things like that. It's been relatively positive in recent months. Now we're expecting a small slide from 544,000 to 520,000. Okay, here it's stated in millions. It seems like the wrong chart here, but anyway, in general, it's a small slide of, we're expecting a slide of 4.4%. Remember, it's a small, the figures are annualized. That means it's not 500,000 homes or more sold. It's just a 1/12 of that. Anyway, but it is a significant figure. It can give a direction about the growth situation in the US in January, in the first quarter, expectations for the Fed. Everybody's talking in general about better than expected. We all know that we had a weak first quarter. We'll get updated figures. Weak fourth quarter of 2015. We'll get updated figures on Friday. But we know that, on the other hand, the first quarter already looks much, much better. US figures, most of them in recent weeks are coming out better than expected. Okay, that doesn't mean a rate hike in March. It does mean still better prospects for another rate hike this year, and not a total doom and gloom atmosphere. Okay, what else do we have today? The crude oil inventories. Why is this important? Why am I talking about oil when it's everything about Forex? Because oil has a lot of impact. Oil has an impact on the mood, and that has an impact on currencies, not only the Canadian dollar. So official expectations talk about a buildup of 3.165 million more oil in stocks, in inventories, in storage. Too much oil sloshing around. After last week we had 2.147. Anyway, few things to note here. Yesterday we had the American Petroleum Institute, API, release its figures, and they came out much higher than expected. Okay, this implies that let's look at oil in the meantime. This implies that we're expecting also a big buildup this time, more pressure on oil prices, currently at $31 and WTI. And another thing to note is that if you do dive into this report, not only the crude oil inventories are important, but also the distillates, okay? Also the refined gasoline, which then goes to gas stations. If it's rising, it's of course another point of pressure for oil prices, okay? And if it's falling, of course, there's some kind of lack, some kind of absence, some kind of shortage in oil, and that could imply higher oil prices and a better mood in markets. Remember, mood in markets moves together with oil quite a lot, and it doesn't matter if this is a problem of supply or demand, okay? So if we have Saudi Arabia pumping more, inventories rising, we have more supply of oil, which is good for consumers and not necessarily bad, but for markets, it's doom and gloom. If we have oil prices falling because of a lack of demand, that's already a problem. But anyway, that's the situation over there. Let's see what else we have on the agenda today. We have James Bullard talking at midnight GMT. He's usually optimistic and bullish, and he's not a voting member, so he won't have an impact. And we also have Australian CAPEX, capital expenditure, very important for the RBA. So if you are trading late at night, this should be more meaningful. We're expecting here a slide of 3%, okay, after a big drop of 9.2% last time. This is investment. This is forward-looking. This is of importance for the Australian dollar. Okay, let's see if you have any questions. Good morning, everybody. What are you expecting? What the level expecting for pound dollar? Well, let's take a look at pound dollar. I expect it to break below the recent low of 139.64 because it's just a minor line it reached a few hours ago. I think it could fall even further or just 8 pips from there. 140 could serve as resistance. Further resistance 140.50, 141.25, and 142.30. Support, I don't really know where it is. We're back to lines last seen in 2009. I would say that the round number of 139 works as further support, just because it's a round number. And then 135.10 is sort of the line in the sand, but that's very, very far. Okay? So we're basically in territory last seen 7 years ago. All right? Very, very long time ago. So I don't know what levels to expect on the downside. I can just say that in general, the pound is very, very vulnerable, okay? Because we are still suffering fear about Brexit. 4 months to go. Polls show very close levels, okay? When it's the one poll showed actually that the level that there is more support for leaving than remaining in, okay? Many other polls show 25% undecided. Okay, when you have a quarter of the population undecided, then you never know where it's going to swing. I still believe that most Brits will prefer staying in the EU because of the trade advantages and because of not wanting to change the status quo, rather than leaving into the dark, a leap into the dark, like David Cameron said. Regarding the deal, if it's a good deal or not, I don't know. I think that the goal of David Cameron was to get some kind of deal to show that he fought for Britain, and to get it over with, to win over the right wing wing of his own party, and over UKIP voters. And the goal was not, I mean, it's not that they achieved something. They didn't democratize the European Union, or anyway. Already reaching other topics here, but I think eventually we'll have Brits deciding to stay in the EU, and once we have that, we could have a big relief rally. If, of course, we have eventually a decision to vote no, to vote to leave the EU, it'll be negative for the pound. Until that, we'll have lots of swings in the next 4 months with every opinion poll released. Now, the last 2 opinion polls that were released, one of them was conducted just before on the weekend, some of it before Boris Johnson said his words, some of it afterwards, and the second one is already afterwards. They don't show a big difference. Anyway, we'll have to see things evolve and settle down. If we have at some point a big margin for the stay campaign, means more certainty, let's say 10%, according to opinion polls, deciding to stay in the EU, we could have the pound going back to normal, moving on other stuff. If we have all the time these close calls, uncertainty, lots of people undecided, 2-3% to one decision or the other, we could have the pound sort of most of the time ignoring fundamentals, which are relatively okay in the UK. Okay, the situation isn't that bad, and moving on every opinion poll. So we could even have further falls below 139. But when we have good news, good news regarding the referendum for markets, and we can have pound dollar rising back up, I think we'll have very wild swings for the pound, not only against the dollar, but also against the euro and the yen. Okay, let's talk so much about the pound. Let's see if we have any change. And of course, more questions are welcome. Okay, 139.78. You mentioned crude storage level reaching their maximum capacity a while ago. Is this confirmed by yesterday's 7.1 figures? Well, I think nobody knows exactly where the storage capacity is. Maybe that's on purpose because it's strategic storages, so we don't want to perhaps know exactly where it is. Anyway, yesterday it was the American Petroleum Institute. It is released early in the week on Tuesday, but the more important one is today's release by the EIA, I think, if I'm not mistaken. Not to be confused with the IEA. Sorry for all these initials, but EIA, yes, I was not wrong. It's the Energy Information Administration. It's a government body, okay? Crude oil stockpiles. So it's, I don't know where exactly the limit is, but they're at the highest levels in 80 years. So it's quite significant, to say the least. Okay, so I don't know where the limit is, but if we're getting closer, we're the closest that we were in the past 80 years. Okay. Another comment here: the deal is not looking substantial enough to convince people here, and none of it is legally binding, apparently. Oh, really? It's not even legally binding. Well, I do believe that with the great democratic tradition in the UK, if the people say leave, then we'll have the government work towards leaving the EU. I think it's once they announce it to the EU, it takes 2 years to totally disconnect. So okay, maybe not legally binding, but I believe that all the parties will work towards making it happen if that's what the people want. Anyway, yeah, the deal is not substantial enough to convince people here. Yeah, it looks like lots of smokes and mirrors. So, oh, okay, it has to be made in a treaty to be binding. Yeah, it can be a bit complicated. So, I think that what Cameron did is sort of externalize internal problems within his own party and with UKIP, make it a European problem, and now bring it back to the British people and basically get over it. Keep sort of let's deal with it and stop talking about it. But I think also European leaders didn't like that too much, because we all know he wants to stay in and tell his business donors don't want all this trouble, but he has to win over some votes. Anyway, so is the deal good enough? I don't think so. But what's better for the UK, to stay in or leave? I don't know. Just know what markets want and what they don't want, and how the pound moves up or down. Okay, so another comment here, a question about DAX. Well, there is some correlation, reverse correlation. There used to be, at least, between a bit up again, between stocks in Germany especially and the euro, when we had why can't I, that's not the DAX, here we are. Okay, I only have a daily chart here. Anyway, we're seeing the DAX, the German stock index, moving a bit up. There is some correlation, I mean, up in the bigger scheme of things. From the bottom, the better market mood, we've seen stock prices rising in general, not today, but you have a more gloomy mood. But in general, in the past 2 months or so, when stock prices were up, the euro was down, and when stock markets were down, the euro was up, because the euro is a safe haven currency in times of trouble, has demand. What we are seeing today, and it's a bit different, is we're seeing the dollar strong across the board. It means even though German stocks are falling, and quite a bit, 1.64% today, we are seeing, yeah, it's from today, right? So we are seeing the euro struggling, right? No, that's from yesterday, sorry. Don't know why I don't have here the updated figures, but anyway, we focus here on Forex. Euro dollar is at 110.09. More comments here. Yeah, China bought largest Aussie dairy farm. I didn't hear that news, but if you could provide more details about that. Of course, Chinese are taking advantage of the weak figures. Weak Australian dollar, and in general, they're also buying lots of Australian real estate, also buying houses in California. Remember, the Chinese yuan, despite what US politicians say, it's quite strong, and it's a bit even overvalued. It should be worth less. Okay, it was basically pegged against the US dollar. It means it gained a lot against other currencies, such as the Australian dollar, and yeah, now they're taking advantage of it. Same thing with same thing happened with Japan in the 1980s. The Japanese yen was very strong, and Japanese companies, Japanese investors were buying assets abroad. Okay, question here: can the ECB cut rates further in March, where this has been a major reason for the losses of the European bank earnings? A European bank, the ECB is expected to announce more measures in March. There's been growing speculation about what it can do. The big problem for the ECB is that it doesn't have so many more assets to buy. So it can buy, of course, bank stocks to help boost banks, okay? Not only provide them with cheap money via lending or buying off bonds and giving more liquidity to banks, it can buy also corporate bonds or corporate stocks, okay? Such as bank stocks. That's one option. It'll be much easier for them, though, to cut rates into more negative territory, because so far we have a negative interest rate since June 2014, was minus 10 basis points. Then it was lowered in September 2014 to -20, and most recently in December 2015 to -30 basis points. Now there's speculation that the ECB will cut it all the way to -15 basis points, okay, -0.50. But yeah, that could hurt profits of European banks because they don't always have, okay, they're getting punished by the ECB if they park their money by the ECB. It's supposed to motivate them to lend money to the real economy, but what if they don't have who to lend to? They're actually stuck, and this hurts their profits, of course. Specifically, what the most damaging thing that happened to European banking stocks was fears about Deutsche Bank's holdings of exposure to commodities, okay, to energy companies. So it's more an indirect impact of the fall in oil prices and other commodities rather than the ECB's policy. Anyway, the ECB does have limited tools. The best transmission mechanism so far has been just a lower for longer exchange rate. A weaker euro meant an improvement in the Eurozone economies, more exports, a falling unemployment rate, a bit more lending, not anything spectacular, but still more than nothing, okay? But it has been best seen via the exchange rate than by, really lending, what the ECB's focus is officially about, okay? Anyway, the decision is on March 10th, but we're already seeing lots of speculation about that because of all the talk from the ECB and because and many banks are also releasing their estimates. I've published also something on Forex Crunch. I think it was from Societe Generale and from CIBC, a commentary about the upcoming ECB meeting. Okay, let's take another look at what's going on in currently struggling with 110. Okay, I'll just take another look and see if you have any more questions. Yeah. Anyway, this meeting will become very, very important. I mean, the tension, any speculation towards this meeting will become huge as we get closer. One thing I didn't show you for a long time is the expectations for US rate hike. March 16th is getting closer. Of course, no chance of rate hike on that date. Yeah, well, it's officially a bit higher than it used to be. Instead of 4% chance, it's now 6%. But basically, as of recently, US figures have become better and it's a bit reflected in bond prices. But according to bond markets, we are not expecting a rate hike anytime soon at all. So even for February 2017, markets are pricing in 75% implied probability of no change in rates. Okay, at least it's not a rate cut, but so it could have been worse, but still bond markets remain relatively gloomy. Okay, another comment here. Any country to leave the EU once started can't be reversed under the treaty and takes 2 years to exit. I read very much up on this. UK waffle with agreement cannot have the upper European Courts of Justice in force or not, because any agreement UK makes needs 28 nation inclusion into the treaty. And that takes parliament voting with some countries like Finland. Okay, so whatever UK agreement comes out, it needs to be City of London, where England has its own laws, mayor, police, like a sovereign state inside the center of London, and the 800-year-old corporation that resides over the City of London, a square mile, is controlled by Charles dynasty. Well, in the 80s it was. I think I bet anyone this, just like I bet. Yeah, regarding all the treaties, I think that when there's a will, there's a way. So if the UK were to leave and then there would be interest to get it back inside, and everybody wanted to do that, we could always find a fast track in the treaty change. Remember that the European Union makes the rules as they go. For the City of London, of course, there is an interest to stay within the single market. There's lots of trade with the Eurozone. It cannot be detached. Anyway, I also agree that I also think that eventually Brits will decide, not with a big majority, but it's a clear enough majority, maybe like in Scotland, as you said, 55% to 45% to stay inside. Yeah, City of London is a strange reality. Also, I guess the banks in Frankfurt and also the Wall Street live in their own world. Anyway, let's take another look at the charts. Oh, euro dollar is hugging the 110 level. Pound dollar is still under 140. Okay, it's time for the wrap up. So this is the wrap up for the live market open for Wednesday, February 24th. We're seeing a stronger dollar across the board. Part of it is due to a worsening mood. Markets are less happy than they used to be. Oil is suffering. Iranians said it's ridiculous to cut production. The Saudis are not willing to cut and saying that OPEC will not be a swing producer. But these are not the only things. We had a few good days, so it's also a bit of profit taking. What's different this time is that we're not seeing we're seeing the US dollar stronger across the board. Okay, it's not losing ground against the euro, not losing ground against the yen, just strengthening against other currencies. Most significantly, the British pound. Okay, let's look at the charts. Euro dollar hugging 110, a bit lower on the day, not moving too much. Usually when we have a worse market mood, we're seeing a stronger euro. Same thing with dollar yen, not moving too much. Also here, a round number hugging 112. For euro dollar, support is at 109.60, resistance 110.70. But the biggest story remains the British pound. The British pound dollar fell under 140, reached a low of 139.64. Currently trying to move back up. A resistance at 140.50, 141.25, and 142.30. And to the downside, the low so far is 139.64. And maybe 139 is further support, where levels last seen in March 2009, nearly 7 years. Okay, we had opinion polls showing uncertainty, showing many people are still undecided, and the polls are relatively close. Okay, when we're talking about worse market mood, well, things are not that shabby this morning for the Canadian dollar, but in general, a weaker Canadian dollar with falling oil prices. 139.10 is resistance, 137.20 is support. Aussie dollar 71.40 to 72. Yesterday we were already above 72.20. But now the market mood is not as good. Okay, we are seeing in the past few minutes maybe some improvement, but in general, market mood is not so positive. Same thing with the New Zealand dollar. Between the 65.50 level and 67, we were already above 67. Now we're back down with the worst market mood. Okay, that's what's going on. Yesterday we had a few figures. One of the things that hurt the euro was the IFO business climate, which showed more worries about the future. Housing data was positive in the US, but consumer confidence was bad. All in all, mixed data. The Bank of England is still relatively hawkish, but that's totally ignored by markets which are just thinking about the next words from Boris Johnson, the next opinion polls regarding Brexit. 4 months to go. It's still, of course, a big topic. What do we have today on the agenda? Basically nothing of high importance in the European session, but we have quite a few interesting events. around 3 GMT. At quarter to 3, you have the market services PMI, snapshot of the US, the biggest US sector, according to market. At 3, the most important event for today, the new home sales release, very important for economic activity overall. Let's see if it continues beating expectations like we had with existing home sales and like, other housing figures which look okay. For the wider market mood, crude oil inventories are expected to rise quite a lot because yesterday API was surprising with the big buildup in oil inventories. Okay, so of course, more supply of oil, lower oil prices, worries about the global economy, and of course, dark mood. And late at night, we have bullish bullard talking from the FOMC and Australian capital expenditure. For those trading the Australian dollar, this is a top tier event because the RBA looks at investment, at capital expenditure towards its next decisions. So we're in the middle of the week. We have so slightly worse market mood. The focus remains on the British pound, but also the euro struggling, euro dollar with 110. Let's see how things evolve. Let's see if we have more questions. Yeah. UK will not leave the EU. People of Scotland voted to stay in the UK as opposed to London keeping them in. No, Frankfurt bands are not that occult. Okay, why does third-tier news events have such an impact on market lately? Which one? News used to excuse move against fundamentals. Regarding third-tier events, sometimes it's just the actual release. Markets are waiting for that. When there's no big surprise, that's when they move. Regarding there's also times of the London fix, or when US traders come in, or when stock markets close. So it's not only the third-tier events that have a big market move. If you can point out one specific event, of course I can comment on that. Sometimes markets are looking for an excuse, and as we see here, another comment, investment banks and brokers are trying to manipulate markets. Yeah, there's lots of movement. Sometimes we see jitters around a third-tier event, but it never lasts too much, okay? It's not like a top-tier event which surprises big time to the upside or to the downside, and then we have a long-lasting event, okay? So hope this answers the question. Anyway, 109.99 and 110, hugging the 110 level, euro dollar. Pound dollar is somewhat recovering. No, not that much, 139.79. Let's see how things develop today. Tomorrow we also have important events from the UK, and Friday we have a big close. I'll just mention already ahead in advance that on Friday there will be on FX Street live coverage of the US GDP release, and I'll be there with Mauricio and Dale. So stay tuned. I'll of course remind you all about that on Friday. Okay, so yeah, that's it for today. Thank you very much, everybody, for coming. I wish everybody a safe and successful trading day, and I'll see you tomorrow. So thank you, and bye-bye.